So first of all, just talk to us a little bit about your general strategy and some of the criteria that you use in terms of how you pick the stocks that go into the fund.
We have three underlying premises in managing the fund: a bear market premise, a bull market premise, and an all markets premise. The bear market premise is that in any commodity, only the low-cost producers with strong balance sheets and good management survive. So that's the first thing we look for, is low-cost producers, strong balance sheets, good managements. The bull market premise is that in rising markets, growth drives stock prices. So we also look for companies that have growth profiles, either through production growth or cost cutting or exploration activities. And then finally, in any market, valuation matters. So we pay careful attention to the valuation and try not to overpay for anything.
Well, obviously, gold has been in a bull market recently. So how has that been informing some of your choices?
Well, we try and emphasize all three fairly equally. So it hasn't had any particular driving, more so than usual, impact, because we're always trying to find companies with growth as well as quality.
Well, let's talk about some of those companies that you've been looking at. Northgate Minerals is the first of these, and we're starting here with the smallest pick that you gave us, and this is also the one that folks might be least familiar with. You call this a special situation. It's a relatively small company. Why do you see more potential, perhaps, with this particular stock?
Northgate's principal asset is the Young-Davidson mine in Canada, which they're in the process of constructing. If you take the market cap of Northgate, which is about $1 billion, add all the capital expenditures right through mine closure that's going to be required, divide by the number of ounces that they're likely to produce based on what's proven currently, and then add the cost of production, you're looking at about $900 to $950 an ounce. So basically everything else in the company, the Australian assets, the exploration upside at Young-Davidson, which is considerable, and the optionality at the Chemist underground project are for free. And that's why we think this stock is very attractive. And
as we know, there's also been a lot of consolidation and attempted consolidation in the mining sector. Is that also a possibility for this company?
That's a possibility, but it doesn't seem to have the really large scale would necessarily attract an acquirer at this point. Young-Davidson's probably a 180,000 ounce a year producer when it comes on stream. And I think the big companies are looking for more 500,000 ounce producers.
Well, let's talk about some of the big companies, because you also have some larger cap stocks that are part of your portfolio. And actually, more generally, you're sort of leaning in the larger cap direction right now. Why is that?
We think with the recent M&A fever that's taken place, that the valuation metrics have shifted in favor of the larger cap producers. This is quite a change from where it was 6 months ago. As a result, we think that a company like Barrick Gold, for example, which is selling at about a 10 to 30% discount to the group, depending on the metric you use, very high quality company, diversified, reasonable growth profile as their new mines that are coming on stream are lower cost. Those types of companies are actually fairly compelling investments at this time.
Now, why not try and look at some of the smaller producers that Barrick, for instance, might be acquiring? Is it a matter of valuation that they've gotten too expensive on speculation they might be acquired?
Yeah, at this point we think that they're a little bit on the frothy side based on the speculative M&A interest.
You know, I'm also curious, Mark, whether you look at a Barrick or you look at a Goldcorp, which is another one of your picks, we have seen the price of gold itself and also the gold ETF outperform a lot of these individual mining stocks. I mean, are there going to be any catalysts that are going to help sort of close that gap in performance? I mean, not that these guys have not done well, it's just they haven't been up quite as much as the metal itself.
I think probably the principal catalyst for a lot of the companies is going to be on the exploration side. As they prove up ounces in the ground, then you end up with the optionality associated with those ounces, which should drive those stocks higher versus the underlying commodity itself. And also, I think you're seeing fairly stable costs now, which is in contrast to some couple of years ago. And as a result, more of the any rise in prices should flow through to the bottom line.
Now, when you look at Barrick and Goldcorp, though, is there the prospect that they're going to be increasing production significantly and therefore increasing earnings significantly, or are they going to have to do it by acquiring that production capacity?
Well, both companies actually have fairly good growth profiles. Barrick has about a 3% unit growth, plus their new mines are going to be lower cost, so their growth profile is high single digit. Goldcorp's high single digit in terms of production, and they also have somewhat declining costs, so they're probably going to be low double-digit growth. Plus, in their case, they are making the acquisition of NDN, so that will help give them a next leg as well beyond the next few years.
Mark, I'm also curious, I don't know if the parameters of your fund allow this, but I'm curious if you do own any of the gold ETF.
No, we do not. We prefer to stick with the mining stocks. There are tax advantages to owning the mining stocks versus the ETF, as well as the optionality and operational leverage advantages.
Okay, Mark, thank you so much for joining us to talk about your strategy here. Mark Johnson of USAA, the Precious Metals and Minerals Fund. Appreciate your time.
Quite welcome.